Listen, I'm about to tell you something that's going to completely change how you think about XRP and why institutions aren't diving in headfirst like everyone expected. And trust me, by the time I'm done, you're going to understand why this might be the biggest wealth transfer opportunity sitting right in front of us, and why the smart money is positioning themselves right now while everyone else is asking the wrong questions. So, here's what's really happening. Everyone's screaming, why aren't banks using XRP yet? But that's like asking why Amazon didn't immediately replace every bookstore in 1995. The real question isn't why they're not adopting it. It's why they're being so calculated about it, and what that means for people like us who can see what's coming. I've been watching this space for years, and I can tell you right now, institutions don't move fast. They don't take risks. And they definitely don't rush into anything that could potentially cost them billions if it goes wrong. But here's the kicker. When they do move, when they finally flip that switch, the people who position themselves early are going to see life-changing returns. Let me break this down for you, because what I'm about to share isn't just theory. It's happening right now, behind closed doors in boardrooms you'll never see. First, let's talk about what institutions actually care about. It's not the technology. They already know XRP works. It's not the speed. They know it settles in seconds instead of days. It's not even the cost savings. They know they could save billions on correspondent banking fees. What they care about is one thing: regulatory certainty. And until very recently, we didn't have that in the United States. Think about this from their perspective. You're running a multi-billion-dollar financial institution. Your compliance team is breathing down your neck. Your legal department is paranoid about SEC enforcement. And then someone comes to you and says, hey, let's build our entire cross-border payment infrastructure on this digital asset that the SEC is currently suing the company behind. What would you do? You'd wait. You'd watch. You'd maybe run some small pilots, but you'd never bet the farm on uncertain regulatory ground. But here's what changed everything. July 13th, 2023. Judge Torres ruled that XRP itself is not a security. That was the moment the floodgates started to crack open. Not burst open, crack open. Because institutions don't move overnight, even with good news. And now, with the new administration and Gary Gensler out at the SEC, we're seeing a complete shift in how regulators are approaching digital assets. The fear that kept institutions on the sidelines is evaporating, and what's replacing it is something much more powerful: FOMO at an institutional level. Here's what most people don't understand. Institutions aren't sitting around waiting for regulatory clarity to start planning. They've been preparing for years. While retail investors have been focused on price charts and partnership announcements, the smart money has been building infrastructure. BBVA, Bank of America, SBI Holdings in Japan, these aren't companies that make rash decisions. When they announce partnerships with Ripple, that announcement represents months or years of due diligence, pilot programs, and internal testing. By the time you hear about it, they're already convinced it works. And here's something that should terrify you if you're not paying attention. They're not just testing XRP for small cross-border payments anymore. They're looking at it as the backbone for the entire global financial system's transition to instant settlement. The ISO 2022 messaging standard goes fully live in November 2025. This isn't some technical detail that only nerds care about. This is the foundation that will allow banks worldwide to communicate with standardized data formats. And guess what happens when you combine standardized messaging with a digital asset that can settle instantly? You get a system that makes the current correspondent banking network look like sending messages by horse and buggy. Let me give you some numbers that will blow your mind. The current global cross-border payments market processes about $150 trillion annually. The average cost of these transactions is between 6 to 8%. Do the math, that's roughly $10 trillion in fees every single year. XRP can reduce those costs to fractions of a percent while settling instantly instead of taking 3 to 5 business days. We're not talking about a small improvement here. We're talking about the potential to save the global financial system trillions of dollars annually. But here's the part that gets really interesting. For XRP to handle even a fraction of that volume at the prices we need for instant liquidity, the token price has to be significantly higher than where it is today. This isn't speculation, it's mathematics. Let's say banks want to move $1 trillion daily through XRP. At current prices around $2–3, there simply isn't enough liquid supply to handle that volume without massive price spikes that would make the system unusable. This is why institutions aren't worried about paying higher prices for XRP. They know that for the system to work at global scale, the price has to go much higher. They're not trying to get the best deal, they're trying to position themselves for when this infrastructure goes live. Here's something that most retail investors completely miss. When institutions buy large amounts of any asset, they don't just market buy it like you would on Coinbase. They use sophisticated strategies called TWAP and VWAP, time-weighted and volume-weighted average pricing. Basically, they say, we want to buy $100 million worth of XRP over the next 6 months without moving the price. They work with algorithmic trading firms and OTC desks to slowly accumulate their positions without creating the massive green candles that retail investors expect to see. This is why you might see positive news about XRP adoption and the price barely moves, or moves up temporarily and then comes back down. It's not because the news doesn't matter, it's because the smart money is accumulating quietly while retail investors get frustrated and sell. And here's the beautiful part for people who understand what's happening. Every time the price gets pushed down by frustrated retail sellers, institutions get to accumulate more at better prices. They're not fighting against retail investors. They're benefiting from retail impatience. Let me paint you a picture of what happens when this finally goes live. Right now, there are roughly 56 billion XRP in circulation. Retail investors probably hold somewhere between 2 to 4 billion of that supply. The rest is held by Ripple, early investors, and institutions that have been quietly accumulating. When banks start using XRP for actual transactions, they're going to need to hold significant amounts for liquidity purposes, not just to speculate on the price, to actually use for payments. This is working capital, not investment capital. Let's say just 50 major banks decide they each need 100 million XRP for liquidity. That's 5 billion XRP that comes off the tradable market and sits in bank vaults as working capital. Suddenly, the available supply for trading drops significantly, while demand from actual usage increases. This is what I call the supply shock, and when it happens, the price movement is going to be unlike anything we've seen in crypto before. We're not talking about a pump and dump driven by speculation. We're talking about fundamental demand from institutions that need XRP to run their business operations. I know what you're thinking. We've heard this story before. XRP was supposed to moon when banks started using it, but it never happened. And you're right to be skeptical. But here's why this time is fundamentally different. Previous adoption was theoretical. Banks were testing, piloting, exploring. They weren't committing real money to real infrastructure. Now we're seeing actual business lines being built around digital asset rails. The regulatory environment has shifted dramatically. What used to be a regulatory minefield is becoming a regulatory highway with clear rules and guidelines. The technical infrastructure is proven. We're not dealing with experimental technology anymore. We're dealing with battle-tested systems that have processed billions of dollars in transactions. Most importantly, the competitive pressure is real now. The first banks to successfully implement instant settlement are going to have massive competitive advantages over their peers. The cost of being late to this transition could be existential for some institutions. Here's something that makes this moment in time absolutely unique in financial history. For the first time ever, retail investors can own a piece of the infrastructure that institutions are going to depend on. Think about this. When credit card companies were revolutionizing payments, could you buy stock in the payment rails themselves? When the internet was being built, could you own pieces of the TCP/IP protocol? When banks started using computers, could you buy shares of the computational networks? No. Those infrastructure transitions primarily benefited the companies building the applications, not individual investors who wanted to participate in the underlying technology shift. But with XRP, you literally own a piece of the payment infrastructure. Every token is a bearer asset that represents ownership in the protocol itself. This has never been possible before in technological transitions of this magnitude. And here's the kicker. You can buy it right now, today, on any major exchange. You don't need to be an accredited investor. You don't need millions of dollars. You don't need to know someone who knows someone to get into the deal. But this window won't stay open forever. Once institutions start using this infrastructure at scale, the only way to get exposure will be through financial products they create and control. By then, the asymmetric upside opportunity will be gone. Let me give you some dates that should be burned into your memory. November 2025, full ISO 2022 implementation globally. This is when the messaging standards that enable instant settlement go live worldwide. We are also expecting XRP ETF approvals before the end of 2025. The DTCC has already listed Canary Capital's XRP ETF, which is typically the step right before S1 approval. Multiple central banks are actively working on CBDCs that will be issued on the XRP ledger. Palau, Bhutan, Montenegro, Colombia, these aren't small tests anymore. These are full implementations of national digital currencies. Brad Garlinghouse has stated that Ripple is working with 10 different governments on various projects. R3 is building stablecoin infrastructure. Ripple is applying to become a federally chartered bank. All of these pieces are moving toward the same timeline, and that timeline is accelerating. What used to be someday is becoming next year, and in some cases next quarter. I want to address something that a lot of people get wrong about this space. XRP isn't the only digital asset that could be used for payments. There's XLM, XDC, HBAR, and others that have similar capabilities. But here's what matters in the real world: network effects and institutional adoption. The first network to achieve critical mass with major financial institutions creates a competitive moat that becomes very difficult for competitors to overcome. Right now, XRP has the most institutional partnerships, the most regulatory clarity, and the most developed ecosystem for cross-border payments. That doesn't guarantee success, but it certainly puts it in the best position to capture the majority of this market. And even if other networks capture significant market share, we're talking about a market worth trillions of dollars annually. There's enough value creation here for multiple protocols to be successful, and early investors in any of them could see life-changing returns. Let me be completely honest with you about something that most people in this space don't want to talk about. The biggest risk isn't that this technology won't work. The biggest risk is that you'll sell too early. I've seen this pattern over and over again in previous technological transitions. Early adopters who understand the technology and get positioned early often lack the patience to hold through the volatility and uncertainty that comes before mass adoption. In the dot-com boom, people who bought Amazon at $10 and sold at $50 thought they were geniuses. But people who held until it became the backbone of e-commerce made generational wealth. With XRP, the same dynamic is playing out. The people who are going to make the most money aren't necessarily the ones who get in earliest. They're the ones who understand the end game and have the patience to hold until institutions create the demand that drives the price to levels most people can't imagine. Here's something that might shock you about how institutions think about pricing. They don't care about getting the best deal. They care about getting the right exposure at the right time. Look at MicroStrategy's Bitcoin strategy. Their average buy price is over $70,000 per Bitcoin. Did they care that they could have bought it cheaper years earlier? No. They cared about getting exposure to what they believed would be a strategic asset for their business. The same thing is happening with institutions and XRP. They're not trying to time the bottom or get in at the lowest price. They're trying to position themselves for when this infrastructure becomes critical to their operations. This is why institutions don't view retail investors as competition. They view us as early beta testers who are providing liquidity and proving demand while they build the infrastructure to use this technology at scale. When they are ready to deploy this technology, they'll be happy to buy XRP from retail investors at significantly higher prices because they'll need it for their business operations, not just as an investment. While everyone's focused on price charts, there's a massive infrastructure build-out happening behind the scenes that most people don't see. Ripple's acquisition of Hidden Road gave them a prime brokerage platform. Their partnership with BBVA is moving from pilot to production. The American Bankers Association lists Ripple as a partner for modernizing financial infrastructure. This isn't theoretical anymore, it's operational. The rails are being built right now for institutional adoption at scale. Every quarter, we see more pieces of this infrastructure coming online. And here's what's really exciting. Most of this infrastructure build-out is happening during a period when XRP prices are relatively low. Institutions are building billion-dollar systems around technology they can currently acquire for under $3 per token. That's not sustainable long-term. Either the technology doesn't work at scale, or the price has to rise to support the liquidity needs of the system being built around it. There's one scenario that could accelerate this timeline dramatically: a liquidity crisis in the traditional banking system. If banks suddenly need to move large amounts of money quickly and the correspondent banking system can't handle it, they'll be forced to use alternative rails. We saw hints of this during the regional banking crisis in 2023. When banks needed liquidity fast, traditional systems couldn't provide it quickly enough. Alternative systems that can settle instantly become incredibly valuable during these crisis periods. XRP is specifically designed to handle these types of liquidity crises. It can move any amount of value instantly, 24/7, without counterparty risk. During a traditional banking crisis, this capability becomes priceless. I'm not hoping for a financial crisis, but I am positioned for the possibility that traditional systems fail when they're needed most. History shows that new technologies often get adopted rapidly during crisis periods when old systems break down. The sad reality is that most people will miss this opportunity, not because they don't have access to it, but because they don't have the patience or conviction to hold through the uncertainty. Retail investors tend to buy high and sell low. They get excited when prices are rising and lose confidence when prices are stagnant or falling. They focus on short-term price movements instead of long-term value creation. Institutions think in quarters and years. Retail thinks in days and weeks. This fundamental difference in time horizons is why institutions will ultimately end up with most of the supply, even though retail had the opportunity to accumulate it first. The people who are going to make generational wealth from this transition are the ones who understand that this is an infrastructure play, not a trading play. They're building positions now and holding them until institutions create the demand that drives prices to levels that support global scale usage. Let me give you some numbers that put this opportunity in perspective. The global payments market processes roughly $2 quadrillion annually when you include all forms of transactions: cross-border, domestic, wholesale, retail. If XRP captures even 1% of that market, you're looking at $20 trillion in annual transaction volume. For that volume to settle efficiently, the market cap of XRP would need to be significantly higher than current levels. But here's where it gets really interesting. We're not just talking about replacing existing payment systems. We're talking about enabling new types of transactions that aren't possible with current infrastructure. Instant settlement enables new business models, new financial products, and new forms of commerce that don't exist today. When you factor in the value creation from new economic activity that this technology enables, the total addressable market becomes even larger. One of the biggest challenges with transitioning to new financial infrastructure is coordination. No single bank wants to be the first to adopt new technology, but they also don't want to be the last. This is where regulatory clarity and industry partnerships become crucial. When regulators provide clear guidelines and industry groups coordinate standards, it becomes easier for institutions to move together rather than individually. We're starting to see this coordination happening now. The ISO 2022 standards provide the framework. Regulatory clarity provides the legal certainty. Industry partnerships provide the technical integration. When these pieces come together, and they're coming together right now, the adoption curve becomes very steep very quickly. This isn't going to be a gradual transition over decades. It's going to be a rapid shift over months once the coordination mechanisms are in place. Here's what you need to understand about your position as a retail investor in this transition. You're not competing with institutions, you're front-running them. They know you're here, they know you got in early, and they don't care because there's enough value creation for everyone. The institutions that are going to use this infrastructure are the same institutions that will happily buy your XRP at much higher prices when they need it for operations. You're providing early liquidity and proving demand while they build the systems that will create real usage. This is different from most investments where early investors get diluted by later rounds or where early adoption doesn't translate to financial returns. With XRP, early position holders own pieces of the infrastructure that institutions will depend on. When institutions need this infrastructure to operate their businesses, they'll pay market prices for the tokens they need. And those market prices will be determined by supply and demand dynamics, where supply is fixed and demand is driven by operational necessity, not speculation. If you're thinking about this opportunity in terms of weeks or months, you're going to be disappointed. If you're thinking about it in terms of years, you're probably going to be very happy with the outcome. The infrastructure transitions that create the most wealth happen over multiple years, not multiple quarters. The internet took years to reach mass adoption. Credit cards took years to replace cash for most transactions. Mobile payments took years to become mainstream. But for the people who positioned themselves early and held through the entire transition, the returns were life-changing. The same pattern is playing out with blockchain-based financial infrastructure. The difference this time is that retail investors can participate in the infrastructure transition itself, not just the companies building applications on top of it. That's an unprecedented opportunity, but it requires unprecedented patience. Let me paint you a picture of what success looks like. 5 years from now, when banks need to move money anywhere in the world, they use XRP because it's faster, cheaper, and more reliable than any alternative. When central banks issue digital currencies, they're issued on the XRP ledger because it has the proven infrastructure and institutional adoption. When new financial products are created that require instant settlement, they're built on networks that use XRP for liquidity. In this scenario, XRP isn't just a speculative investment, it's a utility that the global financial system depends on. The price isn't driven by speculation, but by operational necessity. The people who positioned themselves early and held through the transition don't just have investment gains, they have ownership stakes in the infrastructure that powers global finance. This is the opportunity that's sitting in front of us right now. Not guaranteed, but probable, based on the evidence I see from institutional partnerships, regulatory developments, and infrastructure build-out. So here's where it comes down to a decision. Do you believe that the global financial system is going to transition to instant settlement infrastructure? Do you believe that regulatory clarity will enable institutional adoption? Do you believe that the infrastructure being built now will be used at scale? If you answer yes to those questions, then the current prices represent an asymmetric opportunity where the potential upside significantly outweighs the potential downside. If you answer no to those questions, then this entire analysis is irrelevant and you should invest your money elsewhere. But if you're on the fence, consider this. The cost of being wrong about missing this opportunity is much higher than the cost of being wrong about taking it. If this infrastructure transition happens without you, you miss one of the largest wealth transfer events in financial history. If you position yourself and it doesn't happen, you lose money that you could afford to lose. That's the definition of an asymmetric bet. And those are the kinds of opportunities that create generational wealth. The institutions know this transition is coming. The only question is whether retail investors will have the patience and conviction to hold their positions until institutional demand drives prices to levels that support global scale usage. Time will tell, but I know where I'm positioned and I know why. This is not financial advice. This is one person's analysis of market dynamics and technological transitions. Do your own research, understand the risks, and never invest more than you can afford to lose. But also understand that opportunities like this don't come around very often, and when they do, the people who recognize them early and have the conviction to act are the ones who benefit the most. The infrastructure is being built, the partnerships are in place, the regulatory clarity is emerging, the timeline is accelerating. The only question is whether you'll be positioned when institutions flip the switch and this technology moves from experimental to essential. I believe we're closer to that moment than most people realize. And I believe the people who understand what's happening and position themselves accordingly are going to be very happy with the outcome. The choice is yours.